You want to be a millionaire. I totally agree with you. Get some moolah in your life. Really, financial independence is the best present you can give to yourself, as financial independence is freedom. In this video, I will give you an action plan that you can implement to reach financial freedom, starting right now. Hello everyone, my name is Ali Casey and thank you for joining me on StrategyQuant's channel where we discuss finance, investing, algorithmic trading and everything else in between. We want to secure our financial freedom. If you are new to this channel, make sure to subscribe, hit the notification bell so you don't miss any of the great content that I post on this channel. Also, it would be amazing, I would really appreciate it if you can smash the like button, share the video, comment below, as this will signal to Google to push this video to other traders, other investors, so they can get the same value that hopefully you are getting by watching this video. You can watch part 1 of this video in the link in the corner or in the description below. If you watch it, that's great. If you didn't, I can give you the summary right now. You can become a millionaire through either inheritance, lottery ticket, climbing the corporate ladder, starting your own business, or investing. Now all these are legit methods. Of course, the lottery ticket and the inheritance is not up to you, but it is up to you to climb the corporate ladder or start your own business. And of course, it's totally up to you to reach your financial independence through investing. And this video will be about investing. Now, there are many videos that show you how to get to $1 million through investing. On YouTube alone, if you search it, probably you'll find hundreds of videos showing you how to compound interest, invest in the S&P 500, and you will reach $1 million in 30, 40, 60 years, whatever it is. Of course, they don't show you the other problems with that path. And in part 1, I show you the hidden data that all these videos skip, which are mainly inflation, stagnation, and drawdown. And if you want to get into the details of that, please watch part 1. Otherwise, let's start our journey through investing to reach the $1 million. So first, you should drop this investing in the S&P 500 alone. Yes, the US is the global juggernaut economy, although China is really close behind it, but still it's, there is no guarantees in life, and this is one of them. There is no guarantee that the S&P 500 will go on forever producing 8% return. So what you need is a system that exploit momentum on different assets. So one of the most popular systems, it invests 60% in the S&P 500 and 40% in long-term treasuries or intermediate treasuries. This system has produced 9.8% return with a 30% drawdown. So it's already better than the S&P 500 alone, because the S&P returns 8.25 with 55% drawdown. The data tested here is from 1970 till today, and the allocation is fixed, and you rebalance every year. So this is the simplest way to better investment than the S&P 500. Let me show you the difference this makes in our simulation. So if we invest $5,000 at 9.9% at 42 years, we reach again around $1 million. So we just shaved 6 years out of our theoretical timeline to reach this $1 million. Nowadays, we have great tools to check and study all data and figure out better ways to reach better returns. So this is the golden butterfly, and the golden butterfly returns the same thing, 9.9%, but now with 15% drawdown. Again, you only need to rebalance this yearly, and it's gold, long-term treasuries, S&P 500, short-term treasuries, and US small cap. But this portfolio is much better than the 60-40. Why? Because we might be in a different interest rate regime this next decade. So we need something else in the mix. And in this case, we have gold and the small cap value and also short-term treasuries. Now also Dalio has very similar 9.6% at 13% drawdown. Of course, again, this is since 1970. And with Dalio, we get commodities in the mix also. So long-term treasuries, S&P 500, gold, and intermediate treasuries and commodities. So I think these two portfolios are very, very robust. Ray Dalio is managing $80 billion hedge fund. In any case, you can test it, of course. These are all, the data is available, the tools are available to do your own testing. That's the good thing about it. You don't need to take my word or anybody's word for that. Also, keep in mind all these momentum portfolios, there are literally hundreds and hundreds of white paper, peer-reviewed white paper on SSRN to check and vet those portfolios which are there. And there are hundreds of billions of dollars invested in portfolios like these. Okay, now to the golden portfolio that I designed. What's this portfolio? So you can combine multiple portfolios instead of one. So I just showed you Ray Dalio has a portfolio, Golden Butterfly has a portfolio. Of course, there are, probably 50 really, really good portfolios that they have different speeds, they use different assets, and you can combine them into a fund of funds or a portfolio of portfolios to get better returns and better drawdown. So this is the portfolio I designed, and by the way, I use this tool, Allocate Smartly, which there is a link below if you want to subscribe to it. It's really good. And my portfolio returns 17.1% with a 13.6% drawdown since 1970. Now, this is not a optimized way. Again, you can see it's the same allocation, except we're using momentum and not static portfolio. So what does that mean? That means we trade every month following the best momentum and the best asset. And you can see the returns are not astronomical. I mean, we don't beat the S&P 500 every year, but we are consistently producing good returns. So for example, this year, 7.5, already the S&P 500 made more. And in fact, the S&P 500, a lot of years made more. But also we lose less than the S&P 500. So it's not about beating the S&P 500 every year. It's about consistently producing better returns, so you get better average return, and in this case it's 17, but with the added benefit of less than 14% drawdown. That is huge. Remember my story when the world ends in crisis. Of course, this is huge because let's say you and your friend, each one has $1 million in their account. So your friend from 1 million, they will go to 500,000 because of 50% drawdown. At the same time, or maybe not even the same time, at one point in time, your $1 million goes only to 870. That is huge psychologically. That is huge. You can easily keep that portfolio going. You can easily trade that portfolio. While this one, you will capitulate and sell. You need to be extremely good at sticking with your portfolio at 50% drawdown. And mentally, you need to be so strong to accept it. Okay, so at 17.1, again, same 5,000 deposit, 125 per month. We need now 27 years to reach to the theoretical $1 million. So in the beginning, we need 48 years. Now we need only 27 years. Now let's discuss some practical aspects of this scenario. When you're starting out, investing $125 a month, that's not going to stay the same for 27 years. Because let's say you're working Uber now. Okay, you're making, I don't know, $20 an hour. Well, you're not going to stay with Uber for 20 years. And even if you stay with Uber 20, whatever your skill is that you're doing today is going to be better in 5 years and 10 years and 15 years. Yes, every year, theoretically, you're getting better at whatever you're doing. And if you're not, then you should aspire to get better at whatever you're doing. Or you might pick up something new skill that you want to get better at in the future. So theoretically, you can contribute more than 125. Now, I'm not saying first year 125 and next year 500. No, but theoretically, you should grow this by, I don't know, 5%. So if you're contributing 125 a month this January, then supposedly next year it should be $131. Okay? That is extremely acceptable, very practical, and every sane person will do that to increase, let's say, 5% your payment every year. It's totally doable. I mean, even if you're not getting better at your skill, just a simple side hustle, like really, really small side hustle, will get you that 5% increment on your payment per month. So now if I plug that in at 5%, so I shaved another year. Now we are at 26 years. If you are following all these CNBC gurus, YouTuber gurus, coaches, all these amazing people, I have nothing against them, but if you're following them and they're telling you to keep investing in S&P 500, by the way, some of them are legit people. I mean, they're not all scammers, but like I mentioned, some of them they just don't know. So if you're following in their footsteps, investing all every month in the S&P 500, at one point you will see 50% drawdown. Then you should accept this drawdown because that's part of the system. That's part of the S&P 500. It's not a unicorn. We've seen it happen twice in a decade, 31% just now, like last year. And it will only happen more and more at faster rate because everything is getting faster. The economy is getting faster. Everything has derivatives. Globally, we are connected. So these shocks in the market will only get deeper and faster. So if you are accepting that 50%, wouldn't you be able to accept 25%? I mean, it's very logical. If you're accepting 50, why don't you accept 25? 25 is half 50. It's much better. And for that, you will get better returns. So this annualized return, 17.1, is of course on liquid ETFs. This is trading these ETFs, SPY, TIP, LQD, IF. You know, these are very liquid ETFs. In fact, Allocate Smartly only use liquid ETFs. But this is not leveraged. And since these are blue chip ETFs, you can easily leverage them. So if I take 17.1 times 1.5, I will be at 25.65%. I will increase my returns to 17. Of course, I will increase my drawdown. So my drawdown goes from 13.6 to 20.4. So this is 20.4. Why did I say 25? Because you are watching StrategyQuant's channel and we are here legit. This is not a joke again. So the fact is the future will always have bigger drawdowns. So we cannot go 50 before will be more in the future. That's how statistics works. And we cannot argue with math. So you should expect a bigger drawdown in the future. While the number shows 20.4, I give you 25. So it's already, already we picked the highest we can expect. But now we are getting more than 25%. So now at 25, we need only 20 years to reach 1.16. But of course, that is not real. Remember, we have inflation. So now 20 years, so this is 2041, we need about 1.6 million to be a millionaire at that point in time. So let me go to 21, and we are close. So 21 years will get us to be a millionaire, including inflation rate. 21 years will get to $1 million after inflation. If you are 30 years, that's 51. If you are 40 years, that's 61. That's not even retirement age. If you are 45, that's your retirement age. 66, your retirement age. You are $1 million at that point in time. So that is definitely doable. Also, that's starting from 5,125. So now I will give you two different scenarios that affect two different people. First scenario is you can contribute more than 125. So say you are working at a better job and now you can contribute 450. 450 is like a car payment here in North America. And if you are working any job, theoretically you can do this. And look at this now. Now you reach $1 million after inflation. So here is the inflation calculation. You need 1.4 million and we are at 1.5 million. And now it's 17 years only. 17 years only. So if you are 25, that is 42 years old. 42 years old to be financially independent. That is amazing in any book, in any scenario, in any blog post. Really, this is great any way you look at it. The other scenario I'm going to give you now is also amazing and it's eye-opening. Say you are in this bucket, for 50 a year, for 50 a month, you get to, in 17 years, to be financially independent. You'll be a millionaire at that point in time after inflation. But say you are 30 years and this happens 17 years, that's 47 years. You get to be a millionaire, and 47, you're still working, you don't need to quit anymore. So you leave that investment running. Let's say you leave it running for an extra 3 years. Only extra 3 years. You double your money. Now, why is that? It take you 17 years to get to 1.5 million. And then only 3 more years to double your money. Because the exponential curve kicks in around 15 years. And that is a really nice trick from our friend math. So the exponential curve, just the slope changes a lot after 15 years. Okay, so then only 3 more years and you double your account. And in fact, if you wait another 6 years, so that's 9 years from reaching that $1.5 million, you will get to 8 times your $1.5 million. You will get to around $12 million in 9 years extra. So 17 years, you get to $1.5 million. Add 9 more years and you get to $12 million. This system will make you a millionaire in no time. Okay. This is, by the way, this is not a highly classified system. You can build this easily using Allocate Smartly or other tools like Portfolio Visualizer, and with a little bit of leverage. So you need to be comfortable. You need to understand how the system works, when you will see the drawdown, what drawdown you should expect, and you can reach it. Of course, this leverage doesn't have to be 50%. If you want to be more conservative, you can borrow 10%, 20%. Doesn't have to be 50%, okay? But all this leverage will reduce your time to get to the millionaire status. Finally, here is a bonus tip. If you are already a millionaire, or if you already have lots of money, you don't want to also keep that stuck in, I don't know, real estate or S&P 500. Again, this system is better for you. Now, if you want to be more conservative, you should reverse the leverage. You should now deleverage. So let's say you want to invest $1 million. Let's say you have $10 million, okay? You said, oh, this is a great system, but 13% drawdown, I cannot tolerate that. I want half of that. So what you do is you put $10 million in the system, but you deleverage it. So you only use $5 million to invest in this system. So now, instead of 17% return, you will get 17. You will get 8.5% return, and instead of 13% drawdown, you will get 6.5% drawdown. So you see, deleveraging works the opposite way. You make half the return, half the drawdown, which of course probably you want it already. You have $10 million. I don't want to see anything above 10 million, anything above 10% drawdown. So that's how you use it both ways. Leveraging up to reach faster, deleveraging to play conservative and keep growing your money with less drawdown. So to summarize, ignore everybody else. Don't follow invest in the S&P 500 alone. Don't follow the 60-40. You have an excellent way to start, which is Dalio portfolio. That should get you 10% return with 13% drawdown. That's really a good start. Again, you have the butterfly portfolio. Same thing, a little bit different assets. So both of these are good. Of course, you can combine both portfolios and still get really good returns. You want to take this step further, then you look to build something that generates 17%. The Dalio portfolio trades once a year. You rebalance them. My portfolio trades once a month, and most momentum systems, they trade once a month. With that and with the monthly contribution, you can reach the $1 million after inflation within 17 years to 28 years, depending on what system you pick and how much you contribute, and so on and so forth. Of course, if you have any questions, any comments, please do so below the video. I'll be more than happy, as I love this subject and I would love to engage with you and answer all your questions. I do read and answer all questions posted in the channel. And if you want to take this further and trade the tactical asset allocation portfolio signals in the Discord server, you can join our server through the link below, alongside the weekly live questions and answer sessions and much more. As always, good luck with your trading, good luck with your investing, stay safe, and I'll see you soon.